Hello, I'm David Frazier, the President and Chief Market Strategist of Frazier and Mayer Research, LLC, the provider of InvestorsMonitor.com and our individual investor service, Frazier's Strategic Allocator. We're recording this week's Internet TV show on Monday, January 23rd at around 2:45 in the afternoon. To begin, I apologize for not providing a video last week. As I stated in our written weekly commentary, unfortunately, we encountered some problems with our video recording equipment and was unable to provide a video. So I apologize very much for not providing a video last week. Having said that, let's get right in to this week's recording, and today I'm going to discuss briefly, very briefly, or I should say review, I don't know how much of a discussion I'm going to get into, our holdings in our three model portfolios, the recent trading action in the U.S. stock market, and a question that one of our subscribers had regarding our fixed income portfolio. So first, I'm just going to pull up a monitor that it's a stock market monitor that I can check the trading action in any given security, earnings reports, numerous factors and pricing of securities regarding the worldwide securities markets. And let me say briefly that, looking at some notes here, we made a total of 13 recommendations during the month of December 2016 and 2 new recommendations during the first few days of January of this year. And since then, we haven't made any new recommendations. Some of you might be thinking, well, why is that? What's going on? And the answer is really, really simple. Unlike a lot of these services, it's not our goal to have a new recommendation every few weeks or once a month, as many of our competitors do. The vast majority of our competitors are constantly, I don't know if constantly is the right word, but continuously on a very regular basis makes new recommendations. And I find it very, very interesting about the vast percentage of our competitors. The vast majority of our competitors never give any recommended allocation percentages regarding, that is, they never tell you how much they recommend for you to put in any given security. So, but they have these never-ending flow of new securities recommendations, and I guess they think that money grows on trees, and it's like, here's a new recommendation, here's another recommendation, here's another recommendation, and oftentimes during that period when they're constantly telling you to buy additional securities, they don't tell you to sell anything. So I'm thinking, well, where do you get the money? And the reality of it is, I think we all know the answer is they seem to think, and I know firsthand knowledge of a few firms that I've either been employed by in the past or did run model portfolios and operated services that some of these entities own. So actually I have firsthand knowledge of what some of their thinking is, and that is, we got to keep people engaged. That's the most important thing. Let's keep them engaged. And, well, it's definitely important in keeping one's clients in any business engaged. That's obviously important. But for me, more importantly, is to provide our clients and subscribers with good recommendations. And what I mean by good is recommendations whereby a lot of research indicates that the risk of losing money is minimal, is very, very low at least, and at the same time that the potential for generating substantial returns is very, very high. So therefore, I'm not going to come out with new recommendations every few weeks just to keep our clients and subscribers engaged. I'm going to come out with new recommendations whenever the environment suggests that that there's a security whereby the reward to risk ratio is very, very high. Or if we could flip that around and talk in terms of how most financial market advisors, money managers, and newsletter writers speak, and that is the reward to risk ratio is very, very low. So during the month of December and the first few days of January, there were several securities that my research indicated that were trading at a level that indicates to me that the reward to risk ratio is high, or was high at that time. And therefore I recommended buying those securities. Now, well, some of those securities have moved up in price since then, and some of them have moved down in price. Well, I don't expect to be able to get my timing exactly correct. I mean, you know, people that claim that they get everything correct, well, a lot of those people end up in jail because they're lying. And, you know, I don't expect to be able to get my timing exactly correct. And so I don't concern myself with that. Now, I monitor any securities that I recommend very, very closely every day of the week, every trading day of the week, every day of the week that the markets are open, because I never assume that I'm going to turn out to be correct. And so I'm telling you now that I assure you that I'm always monitoring any securities that I recommend on a regular basis, because I want to always minimize our losses and help you, our clients and subscribers, minimize your losses when things don't work out as we expect. Because we're going to have losses. I mean, people that tell you that we're not going to have losses, well, they're lying to you. We're going to have losses. The goal is to minimize our losses and to maximize our gains, and most importantly, to maximize our overall portfolio returns. And that's why, you know, I will give advice on how much I think that our subscribers in general should put, how much of their money they should put in any given securities. It's the overall portfolio returns that matters most. You know, if you have 2% of your money in one security and it triples in price, well, it's not really going to add much to your overall return. And vice versa, if you have 50% of your money in a particular security and it falls a lot, well, you're gonna get hurt. So it's the overall portfolio holdings. Okay, enough about that. So let's take a look at what we're spoke about that.
So I don't want to really, you know, have these weekly TV shows be too long where you're going to get bored and you're not going to want to watch it. And so what I'm looking at the moment is just I'm mumbling here, is I'm looking at my computer monitor where I see the live trading action in the markets today on Monday, January 23rd, and I'm going to go through and look quickly at stock market indices from around the globe. And I see at around 2:45 in the afternoon on Tuesday, the Dow's down around 42 points. The S&P 500 index, let me take a look at it. It's down approximately 0.3%. The NASDAQ Composite Index is pretty much flat. And the Small Cap Russell 2000 Index, oh, can't find it. Where in the world is it? There it is. It's down about 0.5%. So it looks like this sideways trading action with a little bit of a downward bias for U.S. stocks in general is at least that we've had for a couple of weeks now. Really, you could go back when I say a couple of weeks. I got to take a look at another screen. If you'll bear with me for a moment. It's going back, I think, to mid-December, and that is correct. We've really had mostly sideways movement in the overall U.S. stock market since mid-December. That's really for large cap stocks, though. As I've mentioned in my weekly written commentaries, we've had a little bit of movement up in the technology-heavy NASDAQ Composite Index, and we've had small cap stocks in general, as measured by the Russell 2000 Index, move down a bit over since mid-December. And it looks like we can see that happen again this week. I don't know. As far as I'm not going to get into foreign stocks because I've already written about that as I do every week in our written commentary. So what I think is going on here is what I stated in last week's written commentary, and that is we obviously have a lot of uncertainty about what the United States new president, Donald Trump, what types of executive actions he's going to sign, and which of his proposals the Congress is going to get working on very, very quickly. And we don't know what's going to happen. So we're seeing some uncertainty here. But we're not seeing stocks fall apart, and that doesn't surprise me. Of course they're not falling apart, because the economic situation really around the globe, I guess, in general, overall, is getting more and more positive. That's not true for Brazil. Brazil is still in a horrible situation. But my research indicates that they're going to come out of this horrendous recession that they've experienced for about 2.5 years. My research indicates they're going to come out of that recession by June of this year. So we have some political uncertainty, but the economic environment is still very, very strong. So I think that's enough about the overall financial markets or the stock markets. I'm not going to talk about bonds. I mean, I'll keep it real short. If you have bonds, and they're unless you're planning on holding them to maturity, boy, you should probably get out of those bonds if you haven't. If you're still holding them. I mean, especially long-term bonds. I mean, interest rates are going to move higher this year. There's no doubt in my mind about that, and therefore, just makes no sense to be holding long-term bonds unless you plan on holding them to maturity. And that's a totally different situation. Okay, but enough about the overall market. As far as our individual model portfolio recommendations and holdings, put on my glasses so I can see a little better, at least close up. Let's see. First, I'm going to go to our growth and income portfolio. And I'm happy with our holdings. I think we're positioned very, very well. We haven't had any really major movements in any of our growth and income portfolio holdings over the past few weeks. We saw this medical device fund move up in late December and early January, but then it's pulled back a bit over the past few weeks. We have seen a nice movement up in this Guggenheim shipping ETF. Continued to move higher last week. Our fixed income portfolio holdings in the JP Morgan Alerian MLP index, as well as in the UBS eTrax Alerian MLP infrastructure ETN, moved sideways over the past few weeks. They generate good dividends. I just like our holdings overall in that growth and income portfolio, and I don't see any reason to making changes at this time. In our speculative portfolio, we've seen securities bounce around a bit, and that shouldn't be surprising to those of you that have followed those portfolio recommendations, especially, that is a speculative portfolio. I expect there to be more volatility in the securities that I recommend for that portfolio. I recommended, it's been about 2 weeks now, I think, selling the ETFS, Physical Palladium Shares ETF, we made about a 15% return in that recommendation in the course of only a few weeks. And then last Friday, after it then did move lower a few days after I recommended selling it, it jumped in price last Friday, but it's pulled back a bit today. So monitoring that very, very closely, and we'll likely go back into it, or recommend that you go back into it. Those of you that follow my speculative portfolio holdings, when it looks like the time is right. Don't expect the time to get perfect, the time to be perfect, but I'm generally overall, I'm been pretty good over the past at least 15 years now in my overall timing. I don't mean daily or weekly, but at getting in at good reward to risk entry levels. Let's see, the Stanley Furniture stock, it's moved even a bit lower here over the past couple weeks, but I've only advised our clients and subscribers to put only 5% of their speculative money into that stock. So we're down probably about 10% in that, maybe 12%, but with only 5% of your money in it, and hopefully you haven't put more of your money into that. That doesn't bother me, and it shouldn't bother you, and especially because I think there's a very, very good probability that this stock could be up 5 or 10-fold or even 20-fold within the next couple of years. Yes, 5, 10, or even 20-fold. I'm not saying that's going to happen. I've mentioned this before, but I like what I see in this. It looks like it has a very good chance of being a huge, huge winner. On the other hand, of course, there's always risk, especially for stocks that are trading for less than $5 a share, and this is trading for less than $1 a share. There's always risk in those securities. Okay, now let's move on to our fixed income portfolio, and of course, some of the recommended holdings for that portfolio are also recommended holdings for our growth and income portfolio. So I've already mentioned AMJ and MLPI. Our healthcare REIT is just trading pretty much sideways for the past couple of weeks, but come on, medical devices ETF. This ETF holds a lot of medical device stocks. To me, that's just a no-brainer. Of course, we're going to see the demand for medical devices continue to rise during the months and years ahead. And I like our recommended holding in the Vanguard REIT ETF. And I've told you why in either our monthly journal or weekly commentaries or trade alerts. So there's no reason to get into any details there. So I want to now get into the last part of today's or this week's internet TV show and discuss a question regarding our income recommendations. And the question was the person seemed to be a little surprised, a little confused that I think we have only 6 recommended holdings for that portfolio. I think is what we have. Yeah, only 6 recommended holdings. In contrast, many investment advisors, money managers, portfolio, mutual fund, well, of course, mutual fund portfolio managers, so let's exclude them, and investment newsletter firms and writers, often for a fixed income portfolio, they'll have 20 or 30 or even more recommended holdings, even more than that for a fixed income portfolio. That's never made any sense to me. Why would you have all 20 to 30 holdings? It's completely unnecessary. My goal is to do a ton of research and to try to find securities that have the best reward to risk characteristics. And for a fixed income portfolio, well, I want to recommend securities that are going to generate some healthy annualized dividends. So let's get on to another part of this question. The same person said, I'm surprised that you only have 6 recommended holdings, and I'm also surprised that I don't see Johnson & Johnson or Procter & Gamble or Coca-Cola as some recommended holdings. Well, my answer is very, very simple. Johnson & Johnson, I should have put it up beforehand. Please forgive me. Let's see if I can find it here real quickly. I meant to just about it.
Let's see, Johnson & Johnson. Let's take a look at today on Monday, January the 23rd. The 3% per year on their securities, on their fixed income holdings. I want to earn as high as a boat as I can, as long as I don't need to take on a lot of risk. And the securities that I've recommended for our fixed income clients that comprise our fixed income portfolio, well, the lowest rating of those securities is the Vanguard REIT ETF, and as of this moment, its current yield is right around 5%. That's the lowest yielding one. And then we look at the Nuveen S&P 500 Buy Right Income Fund, and that's yielding an annualized dividend yield of 7%. And if there was a lot of risk in those securities, well, I wouldn't be recommending them. But there's not. There's very low risk in all of the securities that I've recommended for our fixed income portfolio. Yet they're yielding between 5% and 7% on an annualized basis. Those are the type of securities that I like to recommend for a fixed income portfolio. Instead of coming out with a new recommendation every few weeks, instead of recommending 15, 20, 30 different securities, let's focus on the ones that have low risk and yet at the same time pay a high return. And that's why I have advised our clients and subscribers to put 25% of their fixed income holdings in this Nuveen S&P 500 Buy Right Income Fund. And I'd kind of like to recommend even a higher percentage in that. But I never like to load up too much, or I don't know what too much is. I don't want to, I think 25% of one's overall fixed income assets in one securities, I think that's high enough. And there's very little risk, very little. There's almost, the only way you're going to lose money in this Nuveen S&P 500 Buy Right Fund is if the S&P 500 index falls sharply. I mean, unless it falls 20, 25, 30% or more, like it did back in 2008. If the S&P 500 falls, say, 10% in value, you're probably going to break even on this your overall return in this S&P 500 Buy Right Fund, because you're going to be getting those premiums from the call options that the fund writes on a monthly basis. Yeah, I don't know if you would break even. You might be down a few percentage points, but only a few percentage points. If it trades sideways, S&P 500, or moves higher, you're going to make positive returns. So that's the short answer as to why I don't recommend a lot of securities, and I don't recommend these big name, well-known dividend-paying securities such as Coca-Cola or Procter & Gamble or Johnson & Johnson. There's not anything wrong with those companies, but they pay very low yields. So that's it. I'm sure this took just a half an hour. Hopefully I kept it interesting. I'm trying to keep it interesting. So thank you for listening, and I'll speak with you again approximately a week from now.